Welcome to Shadow of Truth with your host Dave Kranzler from InvestmentResearchDynamics.com and Rory Hall from thedailycoin.org. And today is Tuesday, May the 12th, 2015. And we have on the line Mr. John Crudele, who is a reporter for the New York Post. We did not necessarily agree with everything that Mr. Crudele is going to speak about today and reference today. There are notes made throughout this video pointing out where we disagree with him completely. A lot of what he has to offer is spot on, and he's one of the few people in mainstream media that's willing to tell the truth. Without any further ado, Mr. John Crudele. And I understand that you are one of the few, if not the only one, the only person out there that is willing to tell the truth in the mainstream media.
You know what? I'm not sure if I'm the only one, but I just do what I have to do.
Yes, sir, and it's certainly appreciated. And Dave, you want to get us kicked off here?
Sure, John. I have to say, I mean, I can't really think of anyone else out there that I'm aware of that is willing to dig into everything that you dig into and report it as you see it and as you find it to be, as opposed to conforming to whatever the editors of whatever newspaper or the reporter is working for determines should be reported to the public.
Well, I can't speak for anyone else, but I have absolutely complete support from my editors. And this goes back to the time when I was looking into the Bush administration and the Clinton administration and now Obama. So it really doesn't matter who's in office. We just look into these numbers as carefully as we can.
It seems like you focus pretty much on the jobs market. Is that right, or do you venture out into other? You said you covered the Bush administration and the Clinton administration.
I've been doing this a long time, so over the years I've looked into a lot of different things. The job market has been something that has been consistent that I've looked into, and the reason is simple: it's so important to the country. Right now, we have a job market that is not doing great. It's doing okay, but it's still doing much better than the economy overall. So the logical person says, why is that happening? It's either something we're not understanding correctly or the numbers are wrong. And don't get me wrong, it's not always that the numbers are being fudged or fooled with. It happens sometimes simply because the numbers are bad.
In that regard, I guess you've got something like 6 Freedom of Information Act inquiries with the Census Bureau.
Well, let me back up, okay? 2 years ago, almost 2 years ago, I got information from a whistleblower who said that data at the Census Bureau in one instance was being falsified, had been falsified. Census Bureau caught it, never disclosed it, and it could have had an impact on the unemployment rate. The person who did it was let go, and everything was hushed up. So we looked a little bit deeper into it, a lot deeper into it, and we found that this was an ongoing problem in I think it was 5 of the 6 census regions. Now, the Census Bureau does the surveys for the Labor Department that goes into the unemployment rate. So if someone's screwing around with those numbers, the unemployment rate's going to be wrong. And it was significant enough that this one gentleman was creating out of thin air at least 100 surveys a month, which was the equivalent of interviewing 50,000 people, because obviously it's a scientific survey. So we discovered that, and we looked into it a little bit more, and we found that there was some cushy deals with politicians in various states, and we put FOIA requests in. We have at least 6 in right now, and they're being ignored. We're pursuing them.
That's good. I hope that you continue to pursue them, and I hope that you're able to shed some light on that, because I would agree wholeheartedly that what we get it's kind of farcical, in my opinion. I mean,
the unemployment rate
important.
Right. The unemployment rate in and of itself is a joke, because the unemployment rate, the way it is structured, the rate will go down as people become disenchanted with the economy or disillusioned about finding a job, and they, after a year, if when they go to your house and they knock on your door and say, have you been looking for work? And you say, no, I haven't looked in a year because I know there are no jobs out there. Suddenly you're no longer unemployed. You just fall off the numbers. So in the extreme situation where absolutely nobody is looking for work anymore, the unemployment rate would be zero. The unemployment rate in an economy that is encouraging people to look for jobs, the unemployment rate should be going up because people are coming back into the workforce. They're no longer disillusioned.
Okay, so clearly there's, I guess sort of the worst case to put it, there's foul play going on the front end in terms of the data gathering. Certainly the data gathering mechanisms they're using are proven to be unreliable, and your investigation into that reinforces that. One of the other allegations out there is that no one knows, the Bureau of Labor Statistics takes this data that the Census Bureau gets, and then they stick it through a seasonal adjustment meat grinder and an annualized, they annualize the rate. Has anyone looked into, or have you thought about looking into the statistical manipulations that the Bureau of Labor Statistics statisticians impose on the data?
Well, I mean, there's several problems here. Number one is seasonal adjustments. Seasonal adjustments are a totally legitimate thing to do because obviously at times of the season, Christmas time, summer, these labor markets do unusual things that you have to smooth them out, or else the data would be impossible to read. The problem is that the seasonal adjustment that is being used by the government does a look back of 5 or more years. Okay, so what you're assuming with these seasonal adjustments is that these were normal 5 years. So normally in the spring of 2014, 13, 12, 11, and 10, it does this sort of thing. Okay, but these were very unusual years because of the so-called Great Recession. So it's not, the seasonal adjustments are going to be off. I remember a couple of years ago, I was looking into the inflation rate. And the inflation rate just didn't seem right. It just seemed odd. I remember it was springtime. It was probably 3 years ago. And so I called the Commerce Department, got in touch with the head of the guy who was in charge of the CPI, the Consumer Price Index. And I said to him very politely, I said, your numbers look off. If you have gasoline prices going up a lot less than they seem to have. And he said to me, you're right, they're off. They're wrong. And he said they're going to be corrected, automatically over the next couple of months. And I was a little shocked that he was, so honest about it. One of the reasons was he was retiring in a couple of months, so I don't think he cared. And sure enough, in the summertime, gas prices, looked like were actually going up faster statistically than they actually went in the real world. So there's a couple problems here. Number one, to that man whose name I've forgotten, this was nothing unusual because these numbers were going to correct themselves because seasonal adjustment patterns go year-round and they self-correct. The problem is that Wall Street takes these things as gospel every time they're announced. So if they say that 223,000 jobs were created last month, and that was the Friday number, then they say, well, it must be that number. Well, it's not that number. The numbers that the government puts out are always revised. And maybe 5 years from now, they'll have a good handle on what happened in the spring of 2015, but they don't now. And I don't think they even would claim to. It's the politicians who run out there and say, oh, look at these numbers. And it's Wall Street that trades off them as if they were gold. They're not. They're estimates. And then the other problem is they have something that I think is hilarious, and I'm waiting for an answer back from the Bureau of Labor Statistics on this one, called the birth-death model. And the birth-death model is a guess on the part of the Labor Department as to how many jobs are being created by companies that are being born, birth. And the offset is the death part. The only problem is there's never any deaths. There's always birth. So obviously, it's biased towards the optimistic. I believe the number in Friday's figure was that there were 220 200. I may be off on these numbers. 223,000 total jobs, or 232, and the birth death number added 213,000 to it. Okay, but it's not even that clear because the birth death number is before seasonal adjustments, and the other one is after seasonal adjustments. And I have a call into the Labor Department right now to find out how much of these guesses, these birth death guesses, are, fall down to the headline number that everybody, says, oh, well, so that must be the number. It's not. It's a guess.
Yeah, we called it imaginary.
Yeah, I agree with you that, seasonal adjustments are certainly legitimate, but I would be interested in seeing the actual statistical programs they use that go into calculating the seasonal adjustments, because in my opinion, there's a lot of room there for tinkering with how the adjustments are done for political purposes.
Well, you know what? I won't get into politics because I don't know, what goes on behind the scenes. But you could go on the BLS.gov website and you could find the raw data that come out with each month. The raw data is not published, in the press release. But if you know how to find it, you can go in there, and right on the BLS website is the raw data. And we noticed that last December and in January, that the raw data did not seem to jive with the seasonal adjustments that they were doing. And I wrote a couple of columns and I said, look, these look off. And sure enough, over the next couple of months, they adjusted the job growth down in December and in January, or January and February. I'd have to look up the articles. So the numbers were wrong. The thing is, though, people notice the first announcement. You don't really notice the revision later. The revision is sort of like, oh, yeah, there's a revision. The first announcement is like, wow, that's the number. So the seasonal adjustments are obviously off. And the Labor Department does something else that's unusual. I had just mentioned the inflation data and how the guy at the Commerce Department who was in charge of it, knew that this was going to self-correct. So he wasn't all that upset about it. Wall Street would just have to wait until it self-corrected, until we knew what the inflation was doing. The Labor Department doesn't use it. They use something called a concurrent seasonal adjustment. Okay, so so it doesn't come full circle to a zero, to net out to zero. The seasonal adjustment gets changed every month. So it's impossible to actually track it. Is that intentional? Is that, some political manipulation? Don't know. It just is. So it's very hard to find what the economy is really doing. I did a column today, and I'm not sure if you saw it or not, on the JOLTS data, the job openings data. And I believe the number had fallen to 4.9 million from 5.1 million. And that seems like an extraordinary number of jobs that are there, not filled. Why aren't these jobs being filled? I had someone a reader of mine, who called me over the weekend and emailed me over the weekend and said, here's one possibility. Every time somebody puts in for a government contract, they report those jobs as job openings. So he was involved in one instance where he was bidding for a contract with the Defense Department that was going to be 100 jobs. And his company then reported that there were 100 jobs available at his company, even though he didn't have the contract yet. And he said that there were 19 other bidders. So in total, that was being reported as 2,000 job openings, when in fact it was only 100. So if those companies were the ones that were picked to be surveyed by the Labor Department, it would give a misreading on the economy.
That's a huge misreading.
Yep.
And I didn't get a chance to read all of that column, John, but I did get into that, and I was very curious as to that particular aspect that you just pointed out, and I'm glad that you addressed it. And I wanted to ask you about your take on inflation. What do you see as the real inflation going on out here in real world?
You know what? I think we have to go back to the way Alan Greenspan, who was not a favorite of mine, but how Alan Greenspan was defining inflation. He wasn't defining inflation as what things cost in the marketplace. He was really talking about asset inflation. And I think that's the inflation that people need to worry about. And I think Janet Yellen last week also said that when she noted that stock prices were quite high, or whatever phrase she used. I think that's the problem. And I think it was a problem for Alan Greenspan back in the late 90s when he was talking about irrational exuberance in the stock market. He was saying, asset prices are too high. There's also a lot of inflation and higher costs in the U.S. economy. It's not necessarily at the grocery store or at the pump, but it is in healthcare costs. It's in education. It's in the big stuff. It's the stuff you can't fit into your shopping cart. It's the stuff that, just weighs you down. Real estate prices in some markets. And all of this is happening when, number one, salaries are not going up very quickly, and people are losing money on, bank account deals. So the only people making money right now are the ones in the equity market, and that's a crapshoot. That it could be just like '99 and 2006. So you're sitting around there, wondering if you're going to wake up the next day and you're still going to have your assets there. So is that worth it?
Not to me.
Not to me either.
I got out of the stock market several years ago.
I agree. The true economic definition of inflation is the increase in the money supply over and above the marginal increase in the amount of wealth that a system puts out. And that goes back to Milton Friedman, who sort of defined it. But that's kind of always what it's been. Basically, if you're printing currency at a greater rate than you're printing the amount of wealth to back that currency, you're going to create inflation.
But of course, we had this period of quantitative easing that printed dollars. Now, those dollars are not supposed to be in the real economy, but they really are. The Fed, is supposed to have isolated that money and bought those bonds and tucked them away in a safe place that they're not going to cause any inflation in the economy. The problem is that some of that money is going in there. The Fed makes money on its portfolio and turns it over to the Treasury Department, which reduces the amount of debt the Treasury Department has. It's good, great. Treasury has $600 billion in a deficit this year, and not $1 trillion. But still, that money is leaching into the real economy. What's the effect of that going to be? Who knows? That's going to go on for years. The Fed is never going to get rid of those bonds that it has. In the meantime, the purchase of those bonds and the effect of keeping interest rates low, it's a unusual and a burdensome tax on most of America. For what purpose? It bailed out the banks and it got the stock market higher. So some people are benefiting, I guess, just not many.
And there is an area where you are seeing phenomenal inflation. And at some point, I think the inflation is going to spread more so into the everyday fit in your grocery cart economy. But look at the price of collectibles. Look at that Picasso painting that just sold. I mean, that's right. That's definitive signs of inflation right there. The stock market. I mean, you got margin
real estate in places like New York.
Yes.
It's people hiding their money in things that they think are going to hold value. Is that Picasso going to be worth $175 million in a couple of years? Who knows? I would think not. Is New York real estate going to maintain its value, at extraordinary levels with all the construction going on in New York City? I don't think so. So all that extra money is flowing into tangible goods.
Yeah, there was there was a condominium over in Monaco that just went on the market a few days ago for $400 million.
I was going to bid for that, but but I looked at my checkbook and I was like 400 million short.
Well, John, if you don't mind, if you would just kind of introduce yourself to our audience. And we're speaking with John Crudele, who is a great reporter for the New York Post. And if you wouldn't mind, John, just give people a little bit of your background.
Sure. I've been a journalist for 40 years. I've worked on the New York Times. I've worked in New York Magazine. I've written for the LA Times, the Washington Post, I've been at the New York Post for 25 years. I've done some TV. I've done some radio. And I'm a skeptic. And you know what? All journalists should be skeptics. The last thing journalists should do is call their friend on Wall Street and ask them what they think about things, because that is, that's like calling a car dealer and asking him what he thinks about some jalopy he's got out and back. Not going to get a straight answer. So what you do is you poke around. I found the most extraordinary thing is the anecdote I just told you when I called the inflation guy up and he said, the numbers look wrong because they are wrong. How hard was that? The phone number was right on top of the press release. I called the guy up. I was pleasant to him. I didn't, sound antagonistic. And he told me what he thought. So, why don't other people do that? Why, doesn't, in the Jolts thing that I just told you about, a reader, sent that to me, sent that notion to me, that idea to me, and I followed up on it. And sure enough, it looks legitimate. So, why take everything at face value? Part of it is because, Wall Street has such a great sway over everything. And, we all aspire to buy $400 million condominiums. I'm just trying to keep people from losing the shack they have.
Exactly. And we're just trying to keep people educated and how to assist you in doing that.
So, John, you're friends with Bill Murphy, GATA's CEO or chairman, and the publisher of the Midas Report at LaMetropoleCafe.com. I have to imagine he's been on your case about looking into the gold manipulation. Have you thought about doing that? You know what?
You guys do a good job on that already. So, why do you need me to look into it as well? You're doing a good job on it. And there's so many other things, many rocks that need to be, turned over. I can't compete with all the people that you have working. And, of the stuff that I just talked about, that's only a fraction of what I do. There's just so many stories out there. And until the bulk of the media starts looking into these things, it's sort of it's open season for me. It's easy pickings. What's the next thing I'm going to look into? And plus, I don't want to, like I said, you guys do a great job. So I'll leave it to you.
I guess part of the problem is GATA and the La Metropole Cafe world kind of has a limited audience, and it doesn't have the type of visibility that, I don't know if I'd call the New York Post national, but certainly has a presence that extends beyond New York City.
Well, I had the labor secretary defending his Jolts numbers today on national TV, so I guess we get around. But
right, exactly. GATA was invited once onto CNBC back in, I think it was 1999, and Bill Murphy told the truth, shocked the heck out of the CNBC hosts, and never invited him back on.
Yeah, that happens to a lot of people. But let me say something in defense of CNBC, which is probably the first time I'll ever defend them. They have a very large amount of time that they have to fill on that station. If they start going against Wall Street and starting putting things on there that Wall Street doesn't like, they won't fill their time slot. They will have people up there whistling. So to bring Bill on, or a few the other people that I know have been banished from there, if they bring them on, they lose 90% of the people that go on the air there, and they can't do that because there'll be dead air time, and that's their problem.
Now, see, don't you think there's a story in that? Why is that the case?
I say that all the time. It's a bad business model that they have. It's a business model where they can't. Who are they going to? Is Bill Murphy going to sit there for 5 hours and fill time without boring people? No, they got to bring in dozens of people or hundreds of people during the week to say things. And what are they going to say? They're coming from Wall Street. What are they going to say?
I understand all that, but why is it that Wall Street should be anti-gold? Why doesn't Wall Street want the gold story to get out there?
Wall Street is anti anything that they're not going to make money off of. I mean, I have a plan to rescue the U.S. economy that involves letting people buy real estate with their retirement plans. Is Wall Street, with some of the money in their retirement plans, is Wall Street going to back that? Absolutely not, because that's going to take money out of Wall Street's pocket. and put it into something that would actually be useful in helping the economy. Wall Street's not going to go for that. And why does Wall Street have such power? Because they have money, because they contribute to politicians, and that's that. So when the world changes and politicians no longer need money to win election, then maybe things will be better. But I'm not holding my breath for that day, and I hope you don't.
No. And John, you said that you cover a lot of different avenues, and what would be one thing that our audience should be on the lookout for that maybe is kind of low on our radar but pretty high on your radar?
I think we talked about most of the important stuff right now. I'm looking into political corruption in Albany. I am looking at political corruption in some of these government agencies. How far will I get with this? Well, if the governments just clam up and they won't give out any information, then you get nowhere. It's always better in journalism when there are others who follow you into the burning building. And so far, as you said early on, there doesn't seem to be many people out there in journalism who are willing to take risks. Part of the reason is, they're all afraid for their jobs, just like everyone else.
Are you familiar with Operation Mockingbird?
No.
Okay.
You gonna tell me what that is?
Well, it's a CIA operation that started in 1954, and it was a program to get journalists in both written and broadcast media in order to propagandize the news. And I was just curious where I was
don't even
going
think
with
they have to do that now. I think people are compliant in the media. Most people will nod and say, "Oh yeah, I agree with you. Let's call the Secretary of Labor up and see what he has to say, and take that as the final word." I thought CNBC today, and you probably haven't seen it, but I did see the clip. I thought they were pretty aggressive with him, pointing. He kept Thomas Perez. He kept saying that economy's doing better. Compare it with this. Compare it with that. And the host for CNBC said, "Well, it doesn't really show up in the GDP. Oh, it'll get better. And that was about as aggressive as I've ever seen them. And now, probably Perez won't go on the next time. They'll say, "Oh no, you were mean to him." When he's not going to go on, and that'll be the last time they'll do that.
Wow.
So I think and back to something that Murphy and I have been talking to for a long time. I think the stock market is rigged. And I don't even think anybody argues with that anymore. We know the Japanese are rigging the stock market. We know the Federal Reserve is verbally rigging the stock market. We see unusual futures trading anytime there's a crisis in stocks. And I'm not even sure that I'm against it. I don't want to see a crash that wipes people out. The question is, can it be sustained for very long? I mean, who's buying these? Who's doing these mystery rallies in the middle of the night? After Europe closes and after the Far East is closed. Don't know. It's going to be interesting.
Isn't quantitative easing by definition, isn't that market rigging?
Well, it certainly rigged the bond market. Yeah. And that goes without saying. That's by definition what it is. And if you're rigging the bond market, I guess you're rigging the stock market. But you know what? I'm talking about things that are much more direct. I'm talking about in 2009, when Goldman Sachs is speaking with the Treasury Secretary, and they are having conversations, and I have the phone logs. I don't have the what the conversations were about, but when Paulson, Treasury Secretary Paulson, talks with the head of Goldman Sachs more in one day than he talks with the Federal Reserve, then I have to figure these guys are up to something. They're not making vacation plans. They're doing something. And then, when the phone call is just a half an hour before some major rally in the stock market, all of which I've documented, I have to figure there was something going on there. And then when you have Tim Geithner saying we did things that we wish we didn't have to, then I figured, hey, that's pretty big admission right there. What could you possibly mean other than, that you rigged the markets? And again, I'm not sure I'm against it. I just don't think that it should be done frequently. I think it should be done as was proposed in, I might be off here, 1989, by a Federal Reserve governor who had just left the board, that it be done in desperate situations, that the Federal Reserve should rig the stock market. You can look it up. Wall Street Journal, October 1989, and I can't remember the governor's name, but he proposed in the Wall Street Journal op-ed that that's what the Federal Reserve should do. And I think the Federal Reserve has done that. Don't know how often, don't know when. They don't call me up, but it's pretty clear. And, you see these rallies, and then people attach reasons later to them. Oh, it happened because sun came out in New York, and the rally, stocks rallied. Nonsense. Someone is playing with the markets, and in addition to that, they are, even if they're not playing with it in that particular day, they're confident that somebody will come to the market's rescue. And that's it.
I remember that. I can't remember the guy's name either, but I remember that.
Robert Heller.
Yeah.
Robert Heller.
That was actually right on the heels of the creation of the working group on financial markets.
This working group on financial markets was created by Ronald Reagan, a Republican, and I believe, right before '89. I think it was after the '87 crash.
It was, it was ratified in '88, and then
right.
And then the working group on financial markets, together with the New York Fed, is what's referred to as the plunge protection team.
Right.
And you're right.
So what do we have? We know that the working group was formed. It's, that's one of the things you could look up. You could look up what Heller proposed in '89 to rig the markets. And, he didn't use the word rig, but he said the Fed should come to the rescue of the markets.
It was for stabilization.
The stock market. Excuse me?
It was, his proposal was to prevent stabilization so that you don't have a disorderly crash where buyers just completely go away because everything's for sale.
Right. And who could argue with that? It's just so the problem is that anytime somebody comes up with a smart idea, people get too smart and they just use it too frequently. So what you have are, markets that get bubbly and Feds that are afraid to do anything about it. And happened with Greenspan, happened now with Yellen. Bernanke certainly wasn't going to do anything about it, but he was in a more troublesome period, and they end up with financial bubbles. And then they afterwards they say they saw it, they knew it, they were doing things about it, but people get hurt. So we'll see where we go.
People get wiped out. Is the problem.
People get wiped out, but people also make a lot of money during periods like that. You just have to know when to hold them and fold them, and that's that. So I think that's the big thing you need to look at. There's going to be hell to pay. One of two things has to happen: is the economy has to suddenly start doing a lot better than it's doing, or it's the financial markets are going to come down unless somebody keeps them up. But right now we have Federal Reserve governors who are warning about it. We have people warning about the fact that the job market looks a lot stronger than it really is because when you compare it with the GDP. So people are getting skeptical. I'm already there, so I don't have to join them. They have to join me on this subject.
Yes, I'm very skeptical on the job market because I just don't see how a collapsing retail economy that's moving to part-time can sustain an economy of our size. I just don't see it.
Well, let me straighten something out. I don't think the U.S. economy is collapsing. Okay, I think the U.S. economy is growing extremely moderately, probably about 2% when all the crap is taken out. But that's after the Federal Reserve has thrown gasoline on it, trying to get it to ignite. And it hasn't. They got 2% growth, and first quarter was barely growing. So the next move could be down rather than up. So this economy now may only be capable of growing 2%, which is not going to find jobs for people, and they're not going to be able to feed their family and do the things Americans like to do. And so that's the problem. I don't think it's doing terrible, and compared to some parts of the world, we're doing good. It's just not doing good by historic standards. It's doing by historic standards.
Do you think that our economy can be sustained by part-time employment because of the Affordable Care Act mandate, which is moving people out of full-time employment?
Companies are doing what they have to do to maintain themselves. The problem is that if the economy were growing faster and corporate profits were better, they wouldn't be taking these shortcuts in order to keep their profits up. They wouldn't be buying back shares to make their per share profits look better. Their executives wouldn't be laying off people. They wouldn't be cutting corners and taking benefits away from people. Companies will tend to be more generous when they can be more generous. And right now, they just don't feel generous because we're in 6 years of a crappy economy, 6 years of a moderately growing economy. And they're just not feeling it. Whether the benefits are higher pay raises or giving people medical insurance or not cutting off what they have, they're going to, businessmen who run companies are not stupid. They're going to, do what is best for their company and for themselves, because their benefits are tied with how the company does, their compensation and all the rest. So they are going to be as selfish as anyone else.
But doesn't that create a vicious cycle?
Yes, I don't think if we're in a 2% economy, it's going to be a vicious cycle. There are going to be people who are not getting what they deserve for their work. Those people are going to cut back. The economy is going to slow. Companies are going to cut back more. It is a vicious cycle where it's not a spiral yet, but we're sliding lower. And we'll see this quarter how we do with the economy. Doesn't look like a gangbusters quarter. It looks better than the first quarter, but so what? So what? We do 2% a year. I mean, that's not going to create the jobs that we need. We need, and again, they tried tricky stuff like quantitative easing, and it didn't work. We're still talking about the economic recovery. What's it now? 7 years into this recession and post-recession, we're still talking about the economic recovery.
I'm a little bit more skeptical than you, John, because I don't see any recovery at all. I mean, I see some bright spots here and there, but that's it. I mean,
no, I'm not. Look, I'm not that optimistic, but the numbers show that we've been growing in the low 2%. Take away the nonsense and the way they calculate it by reducing the amount of inflation, and you probably have growth a little less than 2%. And if that's the maximum growth we can do, then I'm not being optimistic. I'm saying we're in trouble because that just doesn't afford us the lifestyle that we want or that we deserve or that we come to expect. So it's a problem. It's a big problem. And if the next move in the economy is down, well, then it's that 2% is going to look like heaven. These are going to be the good old days. And we're due for a recession right now. Just historically, we've gone long enough. That first quarter of this year looks like it's going to be revised negative when some trade data gets put into it. Is the second quarter going to be in the positive territory, or are we already in a recession? We'll know. We'll probably know a year from now after they revise all their numbers.
You're right. I mean, if you want to believe the government numbers, yeah, there has been some quote unquote growth, but it's been extremely uneven, and the government's own numbers show that, because you've seen the upper 10% is where the wage growth has been. The lower 80% have actually seen their wages declining over the last 6 years. The average real median household monthly income has been declining since 2007. So, yeah, people who work on Wall Street, people who work in Silicon Valley, people who have been involved with the buildup of the healthcare system that's been funded by Obamacare, yeah, those people have benefited. But I think you'll find that probably for 70 to 80% of the economy, of the people that are in this economy, they haven't felt any economic growth. If anything, they've probably felt economic deterioration.
Well, you can tell how ass backwards everything is. when you listen, and I hate to pick on CNBC all the time, but they deserve it. You listen to CNBC and you hear them moaning the fact that oil prices are down. That this is a bad thing. Yeah, it's a bad thing for for anybody in the oil industry and for the investors who populate CNBC, but it's a good thing for everyone else. And they were taken to task today by Perez of the Labor Department, who said 99.9% of the people benefit from lower oil and gas prices, and there's very small people who don't. And I think he was right on that point. I'm glad he stuck it to him, because that's how backwards everything is. Everything is whatever is good for Wall Street is good for the country. Well, it's not, and that's a prime example of how that is incorrect. Oil prices, that when they're lower, they're good for people. I spend $30 to fill my car now instead of $40. So, all right, well, we get everything we need.
I think we did. Probably more than we need.
More than we need.
A lot longer than we took more of your time than we were intending to, John. And
well, that's okay. I'm glad this thing worked.
Oh, it's awesome. It's just been great, and John, I hope that hope you're willing to come back on again in the future, because
we'll
we
do
would
it
love
another
to.
Time, sure. But I think you picked me dry this time.
We picked you dry, but I'll be keeping an eye on your articles.
Absolutely.
And I'll get in contact with you if we need to call you to the mat on something.
Okay. Take care, guys. Have a good day.
Thank you so much.
Thanks, John. You too.
Bye-bye.
Bye-bye.